Good morning and a huge welcome to everybody tuning in for the latest Bridging and Commercial Virtual Roundtable. This time we are doing this in partnership with specialist property lender Lendhub. A warm welcome to Asim and Ashley from Lendhub. Thank you for supporting us in this particular virtual roundtable. We're also joined by 4 esteemed guests who will shortly be introducing themselves. A reminder to those who are watching / listening, you can ask questions to the panel throughout by using the question function on your dashboard. We'll try to get to as many of those as we can throughout the session and possibly at the end. So today's topic it's a particular favorite of mine. We're going to be addressing various quirks and eccentricities that accompany bridging and development finance cases. Although it may appear that these loan types have become more mainstream in the past few years, they are still characterized by no two deals ever really being the same. It comes at a particularly interesting stage in the market because there has been an influx of mortgage brokers and IFAs who've turned their attention to these markets. And we feel it's pertinent to spread awareness of the likely pitfalls so that those who are perhaps less experienced in dealing with these types of cases can anticipate them and better advise clients and better present to lenders, which is equally as important. These quirks are certainly not to be shied away from, quite the opposite. Lenders require full transparency and a warts and all approach to introductions in order to determine their appetite for the deal and which product will best suit the customer's circumstances, not just with a view to complete, but also to redeem successfully and on time. There's an element of creativity which comes with the territory of these types of loans. It can even be encouraged, but as with anything, you need to know the rules in order to know when and how to break them, always with customer outcomes in mind and at the forefront. We will be talking about a range of different things under this topic, including asset and borrower types and profiles, location-specific factors to be aware of, issues around planning, and also the all-important concern of rising costs, which are having an impact on materials for refurb and development projects. So yeah, that just leaves me to hand over to the panel, who I will now just kind of run through to introduce themselves. I think we will start with Asim, if that's okay.
Yeah, sure. Good morning, everyone. Thanks for tuning in. I work as a Chief Commercial Officer for Lendhub. We are a principal lender active in bridging refurbishment development space. Personally, I've been with the company 18 months or so. Previously, well, probably longer than I care to admit, but coming up to 20 years in the trade, mainly with banks, Metro most recently, and then prior to that, Bank of Scotland, Barclays. And yes, really looking forward to our debate. I think we've got a really interesting panel. Thank you, guys.
Thanks, Asim. Ashley, over to you.
Yes, good morning, Karen. Thank you for that introduction. Yeah, so Ashley Kendall here. Hi to everyone on the call. Yes, so I'm the business development manager here at Lendhub. My primary focus is managing new and existing relationships with both direct customers and intermediaries alike. So yeah, that's pretty much me in a nutshell.
Thank you, Ashley. Kim, over to you, a veteran on these roundtables for those who tune in fairly regularly.
Yeah, thanks, Karen, and morning, everyone. My name's Kim Mcginley. I'm the Managing Director of a specialist mortgage brokerage called Vibe Specialist Finance, an ex-lending manager for a couple of the specialist lenders, so I wear a bit of a lender's hat as well as a broker's hat. So yeah, thank you for having me.
Thanks, Kim. Shaz, over to you.
Cheers, Karen. Hi, guys, I'm Shaz Ahmed. I'm a mortgage broker working with GPS Financial. I work mainly with property investors, so it's a lot of bridging development and then the exits on the other side as well. My main focus is to get stuff off my desk as quick as possible and to have a good night's sleep, really. So yeah, thanks for the invite.
Thank you, Shaz. Good to have you on. Joe.
Good morning, everyone. Thank you, Karen. So yeah, my name is Joe Lane. I'm the Director of Mortgage Lane. I'm also a property investor and I use development products myself. So when I'm using the products and services, I always give sort of a personal advice on each deal to my customers. So hopefully can add some value this morning. Thank you.
Absolutely, thanks, Joe. And Ben, I've left you to last because you are a slightly different type of person or type of service on the call today. So if you don't mind taking a couple of extra seconds or minutes to tell us a bit more about what you do at Bridge Shield.
Yeah, sure. Thanks for having me on. So Bridge Shield has a slightly different view of the market to brokers and lenders. We perform two main functions here. The first is to assess loan risk for lenders. So brokers may see our intervention pre-completion, post-valuation, where we perform an audit function and give an opinion to lenders on the risk associated to that loan, and if we feel like it's a comfortable proposition for them. We also deal with back-end recoveries, so we assess loan risk at the front and then recover at the back if necessary.
And then thank you very much, Ben. Great. So we're going to kind of launch into our first part of the discussion, and just hinging off what Ben has just mentioned about risk. We've just come out of a period of sort of quite sustained systemic risk within the market and the world as a whole. But bridging and development cases carry a certain level of risk, which is a bit more complex and it's a little bit more involved. Hence the reason why we feel it's necessary to go through all of these different areas of the topic, so that we can, with a view to understanding why lenders also make the decisions that they make, and why brokers should be presenting information in the right way, so that they can adequately put that risk profile together. That's really important for brokers and potential borrowers to understand, so that it's not an us and them situation between lenders, brokers and borrowers. So I thought I'd just mention that at the top. But we're going to talk about borrower types and profiles to start with, because there are a variety of different types of people who might need bridging and development facilities. And I'd like to talk about some of the differences there from straightforward mortgages and what the panel sees presented to them most often, and the challenging types that can arise there. So Ashley, if it's okay, I'll start with you from a lender perspective, and then we'll get some broker responses there.
Yes, of course. So I've basically subcategorized this group into three main talking points, and we can delve into more details as the discussion sort of opens. So the first sort of topic is the non-standard sort of financial circumstances and self-employed borrowers. So as we see a trend now of, the 9-to-5 sort of going out the door, and more people starting out on their own ventures and becoming their own self-employed entities. I'm seeing more and more inquiries where borrowers have got irregular incomes, and I think from a lender's perspective, especially in the bridging, because in the bridging world we don't really assess income. The focus here is really on the exit. So I think it's very important that lenders and brokers alike, when they're considering using bridging finance, that they analyze their client on what they can get in, say, 12 months time based off that income. So so if the client's intending on refinancing, I think on, like, for example, a buy-to-let term, both the lenders and brokers need to understand which lenders they can consider for these particular client profiles. So secondly, we are seeing a trend of, I would say, first and second time developers taking on more and more complex refurbishments. So this is where, it's not just your typical tart and turn. This is, the double story extension or converting properties into, large HMOs. So sort of 6 to 9 bed units plus. So, if the lender has the appetite for the above, or a bridging lender has the appetite, they need to ensure the client has, a project in the liquid area where, the GDV will be supported, and they'll be able to sell the property once the project's finished. And the customer really needs a strong professional team around them to support the tight timescales for these particular projects. Just as an example, due to the low GDV requirements in today's world, in the current market, there's always a tight budget, and there's always, the scope for delays and cost overruns. So obviously, the good brokers, I'm sure, the guys will explain it further in more information in due course. It's always important to consider the client's ability to deal with problems when if it happens. So if there's any sort of cost overruns, or if there's any delays with COVID, for example, we've just seen where the whole world shut down for a good period of the year. It's very important to take that into account when looking at placing a loan. And then thirdly, foreign nationals with no footprint in the UK. So I think this is also an important topic. We're seeing more and more investment in the UK from overseas clientele that, again, don't have any footprint in the UK. And I think, and obviously I'll let the panelists sort of take lead on this, but from a lender's point of view, I think it's very important that we consider, when clients need to sign documentation. And I know the travel restrictions are easing up now with, the rollout of the vaccines, but, clients getting to the UK to sign the documentation, or what processes we need to put in place to get those paper copies back to the UK. AML KYC, because that's always a difficult point. Meeting the borrower via Zoom call or over Microsoft Teams is something that we've started embedding into a part of our process to account for that issue. And the importance of the client having a UK solicitor that can either translate correctly if it's in a foreign language, or explain the facility agreement in the correct manner to understand what the client's getting into. So I just thought I'd open up the table to anyone else who wants to put in an input on that. But those are the three main points that I think is worth a debate in today's topic.
That's perfect, Ashley, thank you. Shaz, I saw you nodding quite eagerly at the mention of foreign nationals, but what are your views on those three sub-borrower types that Ashley's mentioned?
Yeah, thanks, Karen. Yeah, Ashley's covered them off pretty well and summarised them in the right way. I think what I get a lot of is people who've raised private investment. So, but it's not through conventional means. So they've gone on social media, for example, got a lot of followers. They've put together a pitch deck, and now they've raised £50,000 to £100,000 off 4 other people. I guess it's a case of packaging that up front when you propose to a lender. This is where the money's coming from. And then, of course, it's that thing where they say, well, how much skin in the game has a client got? And often it's very little. But actually, the investor I speak to say, well, Shaz, we'll treat other people's money with probably more care than our own, because it's reputation. But yeah, it's kind of understanding that it's not as easy as someone just giving you money. They've got to have loan agreements in place, deed of subordination, and actually solicitors will do AML checks, potential KYC checks. So even though they've loaned you the money, they're still partially involved in the application, not taking on the risk, but they've got an unsecured loan, but they have to be comfortable giving more than the usual things.
Thanks, Shaz. Joe, what sort of client profiles do you come across perhaps most commonly, or ones that need a little bit more looking into from your point of view? Have we got you on, Joe?
Me?
There you go.
Sorry, what was the question? It's cutting. Sorry.
That's okay. I was just asking you what sort of borrowers that you come across for these types of facilities, either most commonly or the ones that you feel need a little bit more, let's call it work or looking into, to ensure that you're doing the right thing by the lender and the client.
Yeah, sure. So I see a lot of borrower types. So obviously we get personal name limited company broadly. And then, of course, whoever's supplying that personal guarantee then may have like adverse credit or something in the case of maybe limited company. Now, if a borrower has adverse credit, a lot of bridging lenders tend to be non-status, so they're looking at the deal a lot more than the individual. And of course, where the deal stacks, that is generally what bridging lenders are looking for. I did resonate with what Ash said about the foreign nationals, and of course, foreign nationals, if they haven't got a footprint in the UK, can find it really difficult to buy property. And it seems to be a bit of a trend. I've got quite a large market in Hong Kong and Singapore where nationals of those countries are investing in the UK and are looking for funding to get their foot in the door and, of course, get their footprint in the UK. Now, there are mortgage lenders that will do it, albeit can be very, very expensive sometimes for first-time borrowers overseas to get mortgages in the UK. Now, Bridge can be a great experience vehicle, and a lot of the time, those borrowers outside of the UK are looking to do complex strategies such as HMO, such as commercial property, such as serviced accommodation. And of course, that high cash flow strategy usually requires a bit of experience with a mortgage lender, and a Bridge can be a great experience vehicle to enable them to do that. And of course, they pay the price for it. But I think, you know, bridging is certainly a way in which they can do that and make sure that they get one across the line before they've got that footprint. So yeah, pretty much a lot of borrower types I see. And of course, those borrower types who might not have any experience looking to fund refurbs that they don't necessarily have the cash for. And of course, like Ash pointed out, we're looking at them loan to GDV sort of guides, loan to cost, and of course some lenders even profit on cost they have for minimums. So we really do need to be looking at what each deal will profit against the cost, and sort of have that percentage ready when you are going to bridging lenders for your deals.
Thanks, Joe. Asim, just building on what Ashley introduced and Joe's gone on to chat about with the foreign nationals, what does Lendhub do to sort of smooth this particular type of transaction and help those borrowers out? I assume that you do support that market.
Yeah, yes, we do. It's quite an interesting one for me personally, with my background, because you know, I was brought up, you know, when you're looking at a deal, look at the borrower and then work your way out. In a foreign national situation, you look at the property and can almost work your way in. So the start point is slightly different. We do some of the things that Ash said. We underwrite the deal as though it's the deal that we want to underwrite. Doesn't matter who the borrower or where the borrower is domiciled. And then we pick out the things that we might need. So if it's a limited company, I was going to ask the panel what they're seeing, but we are seeing very few offshore structures now, as compared to say 5 years ago. I think the regulation, the cost involved in setting up an offshore entity outweighs anything that you get at the end of it. So they tend now to be quite straightforward borrowing structures where the only thing that's kind of outside of the grid is the individual himself, based in Hong Kong or China or wherever. So we just work off as though this was a normal transaction, except with a few quirks at the end where we want to, well, you know, as basic as are they alive and kicking and do they exist, etc., to who are their advisors? Is it a reputable firm, a local firm they're using? Can we rely on it? And I think it's more a solicitor-led approach as opposed to what we can do, because we so much we can do. We do insist sometimes on having Zoom calls, so we just want to tick that box if we met the customer. But again, you know, it's very difficult to KYC. But I resonate with what Joe said. The exit on some of these so onerous and expensive, there's almost you almost want to have that in the bag before you consider anyone who's not domiciled or based in the UK. We're also seeing a slightly different version of it, where there are, especially in the Asian market, the Chinese market, where there is a small pool of people that are based here and they attract investment from abroad, which is becoming more kind of commonplace than, you know, Mr. and Mrs. whoever over in China wanted to buy a property. And again, we're seeing an influx of Asian money, as in South, you know, money from the subcontinent, Indian money, many from Bangladesh, Pakistan, etc., for people just wanting another base in case they ever wanted to move. So there are different types of borrowers, but yes, our underwriting assessment doesn't change, except for when if we want to do the deal, we just tell them what extra we would need.
Thanks, Asim. Kim, just over to you before we move on to the actual kind of asset question. Anything about borrowers that you'd like to highlight in relation to bridging and development?
Not really. I think the guys have had this completely covered. I think Ash and what Asim was just saying about the exit is absolutely key. I mean, for us guys that are brokers on this panel, I mean, we come across the weird and wonderful. It's, you know, you deal more with complex than you do with standard vanilla type cases. So for us as brokers, before it goes to a lender, it's understanding the questions that we need to ask, the different questions, in order to ascertain the most appropriate bridging lender, also the exit as well. But yeah, also I guess maybe partnerships at the minute are huge. Like Shaz was saying, there is so much business being done on the likes of social media now. And networking groups that are out there. So it's interesting seeing from a client's perspective, if they're kind of inexperienced and they're JVing with someone, how that relationship turns out and how it's come about. So again, that's just something that we're seeing a bit more as well. But no, other than that, completely agree with the guys with what they've said.
It's interesting points about the business being done on social media. It's given me an idea for a whole nother virtual roundtable on that, because it is becoming more popular. Ben, I'm going to come over to you to kick off a bit more about unusual property and asset types. It's been touched on by Joe earlier about the sort of asset first approach that most bridges take when it comes to looking at a facility. Although we have run through some of the borrower types, I think it is very much about the security. So can you tell us a bit about the things that you like to keep an eye on with the unusual asset types?
Sure. I think the first thing we focus on here when we see unusual assets, or any asset really, is just ensuring that the right methodology evaluation has been used. We quite often see standard residential houses, which are quite vanilla, but let out, and they've used a price per square foot application to justify valuation. But actually, there's a long-term tenant in there, and in real terms, if that property has to go into receivership or asset management or possession, and you have to recover it, really the value is underpinned by the yield, and it should be a yield-based methodology applied. And what we tend to do here is, because both are applicable in that scenario, what we tend to do is stress test both methodologies and then assess the disparity and see what the outcome would be in both scenarios, and then see if the loan is still safe along that spectrum. So I think that for us, it's about assessing the right methodology for that particular asset, if that makes sense.
Yeah, absolutely. Shaz, are you seeing any trends in relation to types of assets that are more popular at the moment, that people are increasingly seeking bridging loans for example?
Yeah, sure. So, I mean, maybe last year, 6 months ago, there was a lot of HMO conversions, but I'm seeing a lot more commercial conversions right now. So people picking up stuff on the high street, old disused banks, offices, going to convert into semi-commercial or resi. The challenge there is a lot of the people are thinking that the uplift is going to be 6 title splits at the back end, and that's going to increase the value just because. So again, it's understanding the exit. I think the exit is going to be key with this today's conversation. So what are they doing to the property? What's the end value going to be? And actually, can they get finance on that? Because when they realise the rates on a semi-commercial mortgage, suddenly they're like, oh, maybe it's not worth doing the deal at all anyway. But yeah, commercial conversions seem to be big right now.
Presumably that's heightened by some of the changes in planning, as well as some of the class changes as well, I would presume. That's
it, exactly. Yeah.
It's, demand for those assets at the end has been spoken about quite a bit recently. So I get what you're saying, that it's important to look whether the refinance stacks up too. Ashley, just coming over to you from the lender point of view, anything that sticks out to you from a case perspective of a particularly unusual asset that you've dealt with of late?
Of late, well, in terms of a real life example, well, I think we're seeing, I'd say, an influx of, where there's a commercial asset where obviously the PD's been granted already for the scheme. However, the client it basically anticipates enhancing that planning further, so they require a commercial bridge to enhance that planning. And as a real life sort of example, there's a beautiful plot that we're looking at in Ipswich at the moment, and just as a criteria, it's the last remaining commercial unit on a residential development as such. And the planning's already been granted, and the client wants to enhance that to increase the return on the actual development project. Because at the moment now, with the increase of costs, and again, it links very nicely into the increase of costings, the project's now not as viable as what it was, say, 12 months ago. So now they need a bridge to enhance that planning. And let's just say well, we've already assessed, obviously, the likelihood of that planning being granted, because it's all been submitted at the planning authority. There's obviously taken time to do that, and it's working around the timescales of getting that scheme granted. But once the scheme has, the enhanced scheme has been granted, the overall development proposition increases, so we'll be able to raise the development finance to then exit the bridge. So for me, that's just one real life example of what we're seeing at the moment, where clients have had to take a view on enhancing their own projects that they're working on because of the economic circumstances of increasing costs. And, you know, COVID, unfortunately, has delayed a lot of matters. So, yeah, that's one real life example from a lender's point.
Perfect, Ashley, thank you. Joe, what are your thoughts on property types at the minute that you're seeing and any associated complexities with those that you might like to pinpoint?
Yeah, so Shaz mentioned commercial property, an interesting one. So I'm seeing a lot of my clients looking to acquire guest houses. Now, of course, a guest house is a former hotel, it's C1 use class, and a lot of my clients who are acquiring them generally assume that they would just be C3 residential and still applicable to get a buy-to-let mortgage on that. Now, a lot of the time, we're picking these up and they do need a severe refurb. A lot of them were last done in the 80s, and there are a lot of them are now being repurposed to what's called hyper hotels. Of course, with the travel restrictions COVID has brought, a lot more people are looking at holidays in the UK now, which has created a big demand in those bookings. So investors are onto it as well, and I know leisure over COVID wasn't flavour of the month with the mortgage industry. So with bridging lenders now, as long as they can see the deal working and there is a strong exit, I think with people now using those services in the UK for holidays and even, you know, working away, I think the demand has really driven that market. So I'm seeing a lot of it. And a lot of the things that people don't realise is the exit is actually commercial, where they may need a bit of experience with some lenders, certainly the vanilla avenues, and if they aren't looking at experience, generally they're in the tier 3 bracket. But even in the first instance, doing a refurb to them properties can be extensive. So even bridging lenders may be looking at experience in that case, but also the fact that it's a commercial property and therefore commercial bridging terms would apply to that, which could be lower in loan to value, might not always expect 75%, and then full refurb you might see the initial loan to value at 65 maybe sometimes. But yeah, that's generally it. I think, you know, there are so many property types, but that would be the more common one for me that I'm seeing a lot of.
Thanks, Joe. And Kim, just coming over to you for your thoughts on property types and how these vary and all the different, like you said, weird and wonderful things you can see when the applications are coming across your desk.
Yeah, so I mean, like Shaz said, HMOs even now for us is hugely popular. There's so many people that are turning to higher yielding properties, but I think from our point of view, when it comes to HMOs, there's an understanding of what is a small HMO and what is a large HMO. What is the value? So Ben mentioned earlier, which was great, about, you know, is it a yield-based valuation and when isn't it? And it's having that knowledge to explain to clients, you know, going and using those lenders that maybe will use a yield-based valuation, like the likes of Lendhub are at the moment for one of our cases. And on a small HMO, that's quite few and far between. And again, it's looking at the exit. For anyone that buys a HMO, the 90% of the time they just assume that they can just get this yield-based valuation, and it's not always the case. So that's a huge education part, I guess, from our point of view at the moment. Yeah, like the commercial conversions are still really popular at the moment, being driven forward by the changes with permitted development and things like that. But yeah, HMOs for us are still leading the way.
Very interesting. Asim, just coming over to you, because of the fact that these loans are used to enhance, to invest, to optimize the asset in question, how does that work from you from a communications point of view and a risk point of view when you're dealing with something at the outset and then you're also looking at what the end product is, which ultimately could constitute the exit in the event of sale? How do you keep track of actually this question arises from a conversation I had with a lender where some of the loans they were seeing were being used for things that perhaps were maybe under explained by the client in the first place, and then upon monitoring, you know, it turns out it's 8 bedrooms instead of 6 or something along those lines. So how do you deal with that?
I think most bridging lenders, and we're no different, the way we are the reason why we're in the equation is because there is a value add. people bridge for a reason, because it's not the cheapest way of a mode of borrowing. So we are very well aware of the fact that we need to be almost like an internal stakeholder when it comes to the initial 3, 4, 5 months. For me, it's a judgment call. You look at the borrower, you look at their past experience, look at what they've done, where the property is, how likely are they to get it wrong, and then you offer that degree of monitoring depending on what it is. Obviously, when you take security, you want to make sure that it's being built to the standard, the point that initially agreed. So we do have, depending on what it is, either a very light touch monitoring or an asset management of some kind, where someone internally or externally goes out. But I think the minute a bridging lender loses sight of the fact that you're only there to help them get from A to B, it kind of dilutes why why people are bridging. With the increase, and that's partly down to lockdown, etc., increased re-bridging, that's kind of been a problem for lenders, because already when you go in, there is a reduction in profit because of 12 months worth of interest gone out the door. And the one that Ash mentioned in Ipswich is a good example of that. It was a perfectly viable scheme 12 months ago. It's not anymore, because costs have gone up. We're going to come on to that later. But also, they've had to pay X amount of interest. So we do look at things on a pretty case-by-case basis. Kim made a good point. We do, where there is a reason why we should take a yield-based value, we do, because I think that we feel that's the right thing to do. Having said that, very, very recently, we had a conversation, almost an argument with the valuer, who basically said, look, if that was the case, everyone on the street will convert their house into an HMO and get 100 grand on top. So, where do you draw the line? Who do you, logically, yes, he's right. But, if that's what people want to do, great. But that's not what you do when you live in a home. So it's having those balanced conversations with your suppliers, and equally with the brokers and borrowers, to say, look, yeah, okay, it may not be right for it to be an HMO here, but it's the wrong location or whatever. But those are the awkward conversations we tend to have. Before we move on from this category, one thing that's probably worth spending some time on is properties that have become unusual due to cladding. We never used to have that a year ago. Obviously, there's been a big debate around who's going to pay for it, etc., and we put some money aside in the recent budget. But we are seeing, and this is something that probably everyone will relate to, people go and buy stuff without doing proper DD. I had one last week where this guy bought a little flat in a tall high-rise building, and he said, no, that's fine, I've got an EWS one, it's absolutely fine. So they sent us the EWS one, and it clearly said that it wouldn't pass. So they didn't read it, and the lawyers didn't read it. So it's very important that even standard properties can become almost overnight, can become what we call unusual or mortgageable, etc. I don't know what the panel think of it, but we are, like Kim said, all sorts of weird and wonderful properties. We had one, I'm sure Ben would nod along, where even though it didn't meet it did meet the minimum heights requirement, it was still not given the all clear. So just when you are talking to your people, when we are talking to our guys, you should just make sure that you read every little detail when it comes to cladding.
Ben, I'll come over to you just to respond to that, and to Asim's last point there about detail and making sure that everyone is aware of what is going into the deal, everyone from the broker to the investor and the lender and everyone in question. What are some common things that you see maybe being overlooked, generally speaking?
Cladding is a really good point, actually. We're seeing more appetite now for investors to buy a property with cladding issues, because they can buy them cheap, they're quite often high yielding, and they can ride out the storm and pay out. But what there isn't yet is a method to calculate what the cladding costs are going to be from a remedial perspective. We're actually trying to gather as much data here as we can to look at, is there a method to say how many units are there, what would the apportionment be, and what's a typical conversion cost to render a building safe. At the moment, there's just too much ambiguity out there for these investors. So we've got a couple in recoveries at the moment that we're struggling to sell, 20–30% below the given valuation, just because of that uncertainty. And that certainly is something we're going to see a lot of volatility in that market. And what we think we'll see is that when these buildings are rectified and they are deemed safe and mortgageable, those particular units will be highly sought after and probably sell for a bit of a premium because there'll be a small concentration of stock coming available. And I think we're going to see that happen for a number of years. The other thing I wanted to pick up on, because we've spoken about yield a couple of times, it's just really interesting to understand yield, because we have these discussions a lot. Specifically where there's an HMO involved and you're looking at, we have these conversations with brokers and valuers and so on. They say, oh, but it's a 5% yield or a 6% yield in Southwest London or something. And actually breaking that down and actually looking at your gross to net disparity on yield is really, really important, because HMOs are a really good example. We see HMOs that are relatively self-contained units with their own meters, and the occupants pay their own charges and so on, their own Wi-Fi, everything's included in their monthly cost, not included in additional. Then you see an HMO where the landlord will have to provide Wi-Fi, water, council tax, everything else is included. Your gross to net is massive. So actually it's about calculating the net yield and really understanding what impact that has on the value. It's really important. And then from a loan risk perspective, it's about understanding the volatility of yield expectation, because a 4% yield versus a 5% yield can be a really big impact on loan to value. So there's certainly areas that we're focusing on at the moment.
It's really interesting, Ben. Shaz, for the cladding issue, would that be something that you would welcome, what Ben's talking about, a way in which these could be more adequately valued at the end?
I think, again, it'll just all comes down to the exit, you know. So can they get what they need to get a mortgage on the back end? And if they can't, then is it worth getting into the deal in the first place? So it's interesting that, you know, people like Ben are there to help kind of steer that conversation already. I've not come across any yet where there's been cladding, if I'm honest, across my desk, just because I guess people are avoiding it for any reason. But it's a good point. I think we'll see more of these challenges coming up.
Yeah, let's hope the remedial action for that is as swift as they promise. Okay, so just moving on, I'm going to skip around our agenda slightly because we've touched on the costs and well, materials costs that have changed quite dramatically for projects in the development and refurb sphere. Kim, can I come over to you to talk about how this can complicate things and how you're managing it from a broker point of view to kind of encourage clients to keep on track of their contingencies and things like that?
Yeah, I mean, for the more experienced investors, it's not so much of a conversation because they're already fully aware. They've had ongoing projects throughout the pandemic, so they've kind of ridden that wave. But for the new investors, it's definitely something that we're factoring in to ensure that when we're getting these breakdown of costs and works, that not only is there a contingency that's adequate, but also like the professional costs and everything as well. But I think if anything that we've learned over the last kind of 18 months is, you know, always plan worst case scenario and kind of work backwards from there. So these conversations are definitely being had. I think it does help where you've got an asset manager involved and the valuer, and they're overlooking these costs of works as well, and the lenders themselves. So there is almost that backup as well. But as earlier on in the process as possible, we are having these conversations.
Joe, with your investor clients, are you seeing this increasingly? Are there particular types of project that this is affecting more than others?
So sorry, my internet's quite bad here. Could you repeat the question again? Sorry.
That's okay, no worries. I wanted to find out from you whether there are particular projects that are being more impacted by the rise in materials costs than others, just as per your investor clients.
Yeah, absolutely. So a lot of the time we're having schedule of works sort of submitted to us by our clients, and we're sending them on to lenders. Sometimes we're finding that asset managers are disagreeing with those schedule of works, and as well with development cases, we are seeing some disagreements on price per square foot that could be expected. So yeah, I am, but particularly I've not noticed particularly which costs are spiking the most, but I just think it's overall, and I also think labour costs are impacting people's schedules too.
Ashley, from your point of view as a lender, do you have a particular figure that you want from it as a contingency from developer clients at this point, or is it very much on a case-by-case basis depending on the project?
Yeah, it is. It's on a case-by-case a lot of the time, and really it's looking at every case on its own merit, because like everyone said, like I think all the panelists have mentioned, that no case is the same as each other. You know, different projects vary ever so slightly depending on the type of works that the client's going to be doing, whether they're just doing a simple tartan turn or they're doing a double-story extension, and the type of materials that they'll be using as well during the course of that build will affect, again, the return on costs. So it is difficult. I think it is always good to use a baseline when you're reviewing costings in the first instance on refurbs and more so on development. But you know, there are cases where you could take a view that, you know, if the profit and cost is slightly thinner than what you'd expect, there is a reason for that, and it may be because the client is actually budgeting for that in the first instance, providing the worst case scenario. So there's different ways of looking at it from a lender's point.
Thanks, Ashley. Ben, I just want to come to you. Do you get involved in this part of the process, looking at expectations, to Joe's point, making sure that that's matched up so that the correct calculations are being put in place and that they're being conservative enough in their cost of works?
Absolutely. Development monitoring, or a pre-loan assessment and then development monitoring, something we do a lot of here. There's a couple of points. So first of all, we look at residual modelling. So we look at loan to value versus the residual value, and then ensure that the numbers that have been given are pretty safe and keep the lenders' pennies locked up nicely. And then we can go and do assessments throughout the course of the development and just check that they all sit nicely. What happens behind the scenes before the loan goes ahead is that we actually do a lot of sensitivity analysis on the residual value and see what impact that has on the loan to value. And this is where the development cost discussion really comes into play, because small changes in things like build costs and gross development value can have a really big impact on the residual value and therefore loan to value. So we tend to stress test things like build costs and gross development value from the outset. It'd be remarkable if you could see what happens if you look at a residual value, say at 70% loan to value. If you toggle the build cost up by 10%, that can have a really big impact on the loan to value and actually render something completely not safe. So what we do is we like to make sure it sits within a really safe range, and build cost and gross development value are the biggest. If I said to any one of you that the GDV's dropped by 5% since the loan completed, everyone would agree that that's a completely feasible thing that happens. Or that build costs have gone up by 5 or 10%, everyone would agree that's completely feasible. It's interesting to see what impact that has on loan risk. The other point is that we get a lot of pushback on build schedule, and Joe, this is a question that you raised, and it's really good to have this little bit of friction because we see it quite a lot. It's topical. One of the biggest things that we do here is we look at how a developer would step into this development, pick it up, and what it would cost them to finish it, and that's what the blank residual table looks like. What we get a lot of pushback on is that the borrower's uncle's a carpenter and that he gets a discount at the local plumbing merchants and he can do it a bit less, and the no labour costs because the borrower's on hand with the development, and all of those things are relevant to the risk of the scheme and for the lender to take a view on. But from our point of view, we're trying to make sure that if we have to step in and sell the development, we can do it safely for the numbers that are predicted.
Thank you, Ben. Yeah, there's been a lot of talk about the experience of the team that surrounds the developer, who they've chosen to work with from a contractor point of view and their finance team. So that all adds into the risk, I would imagine. We've got a question from the audience here in relation to in this type of finance, and I'll come to Shaz with this first, it's often the case that lenders have to work in conjunction with one another. As I mentioned earlier about the prevalence of rebridging at the moment, which it's been going on for a few years, to be fair, but it may have been exacerbated slightly by the pandemic. But Shaz, I wanted to find out from you, because that's something that's quite unique to these types of finance, where you've got to look at different charges, you've got to look at structures, you've got mayors in some cases, you've got lenders working with one another. How do you navigate that?
I think it's really important to navigate that and address it really early on up front, because the solicitor needs to be on board with what they've got to do, the work they've got to do to get this all happening on hand, and also the lender's got to be comfortable. But then if you've got, say, 2 or 3 lenders within that structure, they've got to work together to make it happen. And ultimately, it all costs money for the client in terms of legal fees and the paperwork. What I've seen a lot of recently, and I've got some examples, is you've got less, for example, I'll say Lendhub, for example, they're funding a loan, but the client's got existing lending with, just an example, Shawbrook and Hampshire Trust, who've got charges on the limited company. Well, Shawbrook and Hampshire Trust will have to sign deed of postponement to allow the charge, to allow Lendhub to take a charge as well. All this adds money. Now, what I found is when it's the more kind of high street lenders, so Lloyds Bank, for example, they'll sign anything, happy days. But the kind of specialist lenders will say, well, we've got to get our legal team to check this, see if they're happy with it. All of this takes time and adds cost. And if the solicitors aren't on board with it, it just can delay things again and again. And I've had some lenders say to me, oh, the way around this, Shaz, is the client could set up another SPV and just purchase the property and that isn't the solution. I think there needs to be a better solution in place for
that. Asim, I'll come to you with that. What do you find the relationship like working with other lenders in this manner? Do you find there are some challenges involved with the chain there?
Yes, it's I find it depends whether we are refinancing a customer out with their blessing, as in they want the customer out, or they want to keep the customer. So that for me is you get a different attitude depending on what. It's rare that it comes, and Shaz and I worked on a transaction where it did come right at the end and there were reasons for it. But typically when you're assessing a case, if you are lending into an SPV or a group structure where there are other debentures and other charges, fixed charges don't matter. It's usually the debentures that cause a problem. We tend to say at the outset we're going to either need a first ranking debenture because I've got the bigger chunk of the debt, or I'm going to need either a pari passu or a second debenture. And at that point, a typical deal takes 4 to 6 weeks anyway. So at that point, the borrower, the broker, etc., expected to go back to the incumbent bank or the lender and say, look, you're going to have to do that. But Shaz is absolutely right. Sometimes it just gets lost in the process. Sometimes, they have to go back to the credit to get it approved. Sometimes the solicitor at the other end or our end or whatever is slow to spot. There are carve-outs, as you said. It's either a deed of postponement or a deed of subordination, or typically it's a matter of non-crystallization. So they were, in a debenture situation. So it's best endeavors for us. Also, sometimes if we are not the biggest lender, we take a view on it and perhaps not go for the debenture. I mean, the only thing, and most kind of borrowers don't understand that the only thing that we are interested in by requesting when we request a debenture is stepping rights. It doesn't give us anything else. We've got first charge for the property anyway, so it just allows us to appoint a receiver, and you can't do that if you've got someone bigger sitting above us, even though we might be out of pocket. So it's it's again thinking about worst case scenarios. We try and take a pragmatic view of these things. Also, we are not talking 5 years, we're talking 5 months typically in our world. So, how important is it? Like I said, we don't like losing, we would never lose a deal or something like this, but it is quite a prevalent point. It's quite a stressful time for the borrower when they're trying to navigate 3 or 4 different lenders, particularly if you're ending a relationship with, say, Lloyds or whatever. They have no interest in being friendly. Not that they shouldn't be, but that's how it sometimes transpires or comes across. So it's, you just got to keep going.
Thanks very much for that, Asim. I'm just conscious of time, and I want to, speaking of time, I'd like to just get onto the speed and timescales facet to bridging in particular. We may have people watching that strongly associate bridging with speed, which is understandable. There's a lot more to it, which we will know on the panel. But I wanted to just, Shaz has mentioned a number of different things in relation to the charge relationship that can delay matters. Kim, just coming to you, what else should we be conscious of to ensure that timescales are stuck to, and what can derail them?
Yeah, absolutely. So I think one of the biggest things, it's a team effort. That it's not just the lender being quick. It's using the right solicitor. The valuer's got a job to do. The broker's got a job. So it's really hard to actually gauge that, and it's one of the biggest questions we get asked: how long will it take to complete? And I think, yeah, I mean, whilst the lender's speed is key, it's not the be all and end all. And I think it's those conversations we're definitely having up front. I'll be completely honest that the biggest delays we're seeing at the minute is if a client is using the wrong kind of solicitor, especially when it comes to bridging. You want to be using someone that knows kind of bridging inside out. So that's initially the very first conversation that I'm having with my clients. That's what I've trained the team to do as well. So I don't know about the other guys, but yeah, absolutely, it's a massive team effort. And we've said about this so many times, but price isn't the be all and end all when it comes to bridging. There's so many more factors to take into account to using the right lender. But yeah, that's basically our biggest thing at the minute.
Joe, I saw you nodding quite enthusiastically at the mention of borrowers' solicitors. This is extremely common, but what's your take? I think you might be on mute.
Sorry, so what I was saying is it's basically exactly what Kim mentioned. It's the borrower's, the borrower's solicitor. A lot of the time they're using residential solicitors where they don't really understand the complex requisition that comes with the bridging lender, and they overcomplicate it. And generally what we're having to do, the exercise we're having to do, is go to the lender solicitor and ask for an update on what requisition has been satisfied and what hasn't. And a lot of the time we're reporting back to the borrower to give commentary on what has been provided, and a lot of the time they're providing the wrong things on the requisition, and there's too much back and forth, and then eventually you're a month down the line on legals alone. So sometimes we've had bridging cases that have completed in 6 days because we've used the right bridging lender, we used the right well, got lucky with the valuer and used the right solicitor. So them cases can happen, but at the same time, you can easily have a case going on for 3 months with a bridge if you're using the wrong solicitor, for example.
What can, I suppose, people who are new to the market do in that regard when a client comes to them and it's clear that the solicitor isn't particularly experienced in this type of lending? Asim, what would you recommend? How can this conversation be jogged on a bit? Because I feel like this comes up time and time again.
It does, yes. And I mean, most lenders have minimum standard requirements in terms of number of partners, etc., that they allow. The honest answer is not a lot. If a borrower has used that solicitor for the last 20 years because they did their first mortgage and their daughter's mortgage, etc., they're not going to walk away from them. So the only thing that you can do is tell them that, look, it's a false economy. Using them may end up costing you more because the lender's just going to do more work and therefore they're going to charge a higher fee, and we can't control that. It might go to more expensive. So it's that. But in the legal world, a bit like the valuers, particularly leading up to the end of the stamp duty moratorium, they're very, very busy. Lawyers are always very busy because what they do is read. It's whoever shouts the loudest gets heard in that world, unfortunately. So just keep on top of it, keep at it, keep asking for updates. They're not going to provide updates on time. And look, I'm not knocking lawyers here. They have a very difficult job. They miss one thing, it's on them. So it's very important to also do that, but also tell them if case is not particularly urgent, tell them. So when you do send them an urgent case, it carries a bit more weight. Again, like most things, it comes down to relationships. It comes down to, like Kim said, cheapest is not always the best. It's hardly ever. There's a reason why it's cheap. And as long as both parties are getting value, that's when the negotiation should end. And that's what we like to offer. So I don't think there's any way you can get someone away from the lawyer if they don't want to, unless they don't fit the criteria. But you can work with them, nudge them along. And I say this a lot to my intermediary and broker partners we are the only two people who don't get paid. The brokers and the lenders don't get paid if the deal doesn't complete. I have no interest in dragging it out. Why would I? When the borrower said to me, well, why is it taking so long? Well, you tell me. I don't want it to take long. So, and then you have to drill into the reasons, etc. As long as you have good case managers on top of things, nudging them along, etc., that's all you can do. I mean, the guys might disagree, and we can do something else.
Thanks for that, Asim. Perhaps explaining that in those words or some of those words to the borrower a bit more, especially about the propensity for spiraling costs, could make a bit more of a difference. Okay, so again, we've only got a few minutes left, and I'd like to give everyone an opportunity to just have some closing comments. So Ashley, I'll come to you. Anything that we didn't get to, or anything you'd like to leave our viewers with before we close?
I think the key point, and I think everybody sort of touched on it, is just transparency with not only your client at the outset, but with the lenders that you end up using for the particular case. And I think this stems through not only just with bridging, but through the whole life cycle of the loan process, from using the bridging loan to purchase to refurb, and either using the development finance to do the project or going into a term lender. It's about transparency, and when you're dealing with any issues with that client's previously had, or any specific delays, tell the lender in the first instance what the problem is with the case, and they'll be able to deal with it and address the matter in the earliest convenience. Because what you don't want to do is the client to be invested by way of paying for a valuation or in providing the solicitor's undertakings, and then it turns out that either the lender can't complete in time, or there's an issue that wasn't discussed in the first instance that causes the lender to unfortunately pull out. So yes, transparency. You should have a BDM that you should be able to pick up the phone to and answer the phone. My phone goes off all day, 24/7. So yeah, that's the key takeout for me.
Thank you very much, Ashley. Ben, any last input from you for the session today?
We're just picking up on what Ashley just touched on, really, just about transparency and also touching on speed. Quite often asset managers, mainly from a risk perspective, are sometimes seen as a bit of a hurdle, but there's an amazing amount of effort put in our side to try and find a way forward, and to actually find a resolution. And where we're quite often used is where there's a complicated loan and the borrower doesn't want to pay out thousands for a valuation for a lender to decline it. And actually having an asset manager look at it for what is a few £100 rather than thousands can actually speed up that process and be a really good accelerant in either the accepting or the declining of the loan. So it's about being constructive, and I think transparency and communication are really key points that Ashley just raised.
Thanks, Ben. That is a good point. Shaz, over to you for final thoughts.
So yeah, I think just again, Ashley, just to build on that, is start with the quirky and unusual stuff first, because that's what's going to slow things down and make things different. What Kim said, cost isn't king. I think rates aren't king. It's the overall package. And also, I'm keen and happy to see some lenders now looking at open banking, electronic ID, because these things do speed things up and keep the underwriting process quite lean. So that's my takeaway. Is the use of tech should be used to improve things, not slow things down.
Thanks a lot, Shaz. Kim.
Yeah, just wanted to say, I think from our perspective, it all comes down to one thing to have a successful case, and that's communication. And that's the whole step, every step of the way. Being copied into communication, correspondence and things like that is absolutely key. I'd rather get a quick no than a long drawn out no as well. But yeah, and I guess also it's just down to due diligence. We've all got our part to play in that. We've got a due diligence on the clients, but also the lenders that we're working with when it comes to bridging. So yeah, that's it from me.
Thank you very much, Kim. Joe, just closing thoughts.
Can you hear me now, guys? I've just phoned in. Sorry. So are we talking about sort of bridging open banking and stuff? Because that was the last I heard.
It's okay. We've got some audio challenges with you today. It's absolutely fine. We're just on some closing thoughts because we're just about at time. So if there is anything in relation to tech that you would like to talk about, you can leave us with that.
Yeah. I'm finding open banking a lot better because a lot of the time clients do find it hard to provide bank statements, and the right bank statements, even if they do provide them. Now, for us as brokers, like a lot of the time we'd be underwriting the documents before they go up to the lender in the first place, and open banking completely then removes that requirement for us as broker to be due diligent on those bank statements, and of course go straight to the lender for their review. So yeah, I think it makes our life a lot easier as well. And yeah, I'm just really seeing now bridging lenders adopting a more fintech approach, which is great.
It is, yes. Thanks very much, Joe. And Asim, to close the event.
Yes, thanks for that. I feel UK real estate is both fickle and resilient, and it's proven to be time and time again. Rewind 6-8 months, everyone wanted to convert big houses into HMOs. There was a big spike. At the same time, we saw what was labelled as a race for space. Everyone thought they could move out of London or big cities and live in large cottages and work from there. So we couldn't get our heads around, you can't, if you want, if you are going to be living in a urban HMO, you can't do that. Whereas, why are people investing there? And equally, it's not permanent. You may be, you may want to consider 2 or 3 years down the line not moving out. It's very difficult. It's almost impossible to plan ahead. We are an island, as we know. There's only so much real estate, so much land we have, and that for me, that makes it funny. That makes it interesting. That makes it engaging. So long may it continue. And again, there's nothing better than open lines of communication, not only between the brokers and the lenders, but I think within the lending community, we need to make a greater effort to, I don't know, network with each other better, so there are no issues and even when you're dealing with a client that can benefit from that. So that would be my thought, and thank you ever so much for everyone for their contribution.
Thank you, Asim. And yes, I echo your thoughts. Thank you for tuning in. I think that was an excellent conversation. It was very detailed, which is what we like to do here. We like to tackle the high level topics within the sector. So thank you to Lendhub, Asim and Ashley for supporting today's event. And then to Kim, Shaz, Ben and Joe, thanks for your time. Really appreciate you sharing your expert knowledge. I hope everyone's learned something and that you continue to enjoy the rest of your week.